I'm going to introduce Michael Every, Head of Financial Markets, Research, Asia Pacific, Rabobank. Michael Every is going to tell us everything you want to know about the metacrisis. Michael, please join us.
Good morning, everybody. It's a great pleasure to be here with you in person. I do fear, however, that the presentation may bring a great deal of displeasure. So please do bear with me and bring anything up that you like or don't like in the Q&A at the end. I've actually changed the title slightly because I did get that reaction from quite a few people that metacrisis was a bit of a meta problem to try and focus on. So I've changed it to May You Live in Interesting Times, which you probably are aware Westerners believe is a Chinese curse or a Chinese proverb, and we know it isn't. But the reason I'm bringing it up is that everyone is thinking about interest rates and what is currently driving them. And that does tie together with the big picture, which I'm going to be addressing today. So my usual message when I give keynote addresses or addresses at all is geopolitics really matters, much more than people think. And it's coming for all of us one way or another. And if you look at the two fists punching towards each other here, do I need to remind you about what's going on? And of course, there are other potential fists that could appear too. This is Jackson Hole in America, which seems a very, very long way away from that. Very beautiful, relaxing place. But very recently, we just had all the central banks from the world, the major ones, get together and basically make clear that what's going on in the background flows through to what they're going to be doing, which will interrupt or interfere with all of our trade. Because you can see that interest rates have been moving higher, bond yields have been moving higher, commodities have been selling off as a result, and so have stocks. And that's very much due to what central banks have been saying and saying that they're going to be doing. Now, interest rates are moving up absolutely everywhere around the world, apart from in Russia, Turkey, Japan, and China. So it's pretty much a global trend. I mean, you can try and pick out the country you like or don't like in that list at the bottom, but it's one-way traffic, pretty much. So why are our times suddenly becoming so interesting? And why didn't any of the central banks who are paid so much money to look after inflation and to steward the global economy see any of this coming just 12 months ago? Part of what I hear is rate hikes can't help a supply-side shock. And we're all aware that we have a supply-side shock. I will be coming back to that in more detail later. That's absolutely true. And what you can do is look at inflation. For example, that's US inflation on the right-hand side there, stripping out energy and food and shelter and trucks and medicine. You can take out whatever you want. But if rates are kept too low for too long and you have loose fiscal policy, which we currently do, for example, if you write off student loan debt, you will not keep inflation expectations anchored. And in the 1970s, the Fed said, let's ignore oil because oil doesn't matter when oil went up, and we all got 20% inflation. So, yes, supply shock, but we need to do something about rates. Now that ties back to the fact, and this is where metacrisis comes up again, that we do have a Cold War currently unfolding in the background. We have a hot war, which is disrupting things. Commodities have currently been at the forefront. Other markets are following. And this is, as was introduced, a global systemic metacrisis, which is a mega shock which cannot help but flow through to inflation and hence to interest rates. Here's a chart that I put up very, very early in the year when in January we'd published a piece of research saying we were afraid there really was going to be a war in Ukraine, when the market was saying, don't be silly, no one does war anymore. And we were saying, well, we're afraid there will be. We put this up and we said, look, this is the most likely backdrop. If Russia goes in and isn't greeted with flowers but with Molotov cocktails, they're only going to have two choices. They either retreat, and then goodness knows what happens within Russia, or they're going to continue to escalate with violence and with economic war, which will flow through to everybody else. And then the West either blinks and gives them the Russian world, and Putin has just changed Russian foreign policy to now back the idea of a Russian world everywhere, or we keep escalating and the economic war gets worse and we tiptoe towards finding out where the dividing line between World War III is or isn't. And where are we now? We're in the bottom right-hand corner. We hope it gets better, but that's very much the backdrop. Meanwhile, and in the region, we have headlines like this from the serious American press, not just the tabloid press. Foreign Affairs magazine, America must prepare for a war over Taiwan. Now, the author is not saying they want a war, they don't want a war, but they're saying if they don't prepare for one, the risk is there could be one. I'm not getting into the rights or wrongs of that. I'm just sharing that this is happening in the backdrop. What I can say, though, is this. What you're seeing in Ukraine is not a war under the global economic system, which has been the case for most of the wars we've seen all around the world in the past few years. It's a war over what the economic system will look like. Who's going to be making the rules? On what basis? Russia is obviously weaponizing commodities, very obviously, even more so given the news yesterday that they've said if sanctions don't come off, no gas will flow to Europe whatsoever. China and the US can both, in different ways, weaponize supply chains. Both of them are refusing to sell different goods to each other or threatening to. And the US is weaponizing the US dollar and the financial system and SWIFT. If you look at the backdrop here of all these different headlines, it's obvious that the mainstream financial press is now recognizing something that I personally have been warning about since around 2017, and in different forms actually 2015 and 2016, that globalization is under threat. Forces are emerging that are shifting and changing it, that we are seeing a move towards friendshoring, that we are seeing the enemies of globalization circling, that this one, free trade is dead, welcome to freedom trade, for example, or people saying this is an epochal shift that will take years to play out, maybe the rest of this decade. So there's widespread recognition that this is happening. But this again comes back to markets, to interest rates, and to commodity trading on the other side of that interest rate. Central banks were never clever. They were never in control of inflation. All they were was lucky, because geopolitics is what matters. And when geopolitics changes, everything changes. And look here at inflation in the UK, and in fact England before that, going all the way back to the year 1600. You can see inflation sometimes is very high, sometimes very low, sometimes very volatile, sometimes not volatile. And it all depends on the structural backdrop, and the global central banks don't create that. They're the stewards of it, but they don't actually create it. Now I'm going to be running through this very quickly, but look at that red bar on the far right-hand side. That's predicting UK inflation will be 20%. 20% in January. That's an emerging market level, and that's before we get all the tax cuts that the new Prime Minister is talking about on top. So here's a quick pocket history of the UK and that global backdrop. In 1931, the UK goes off of gold, and we've got an empire, and we manage to reflate. Between 1945 and 1970, we're on gold, losing the empire, and we stagnate. In 1971, we go off gold again with no empire, and we inflate. We get high inflation. Then in the 80s and the 90s, we have supply-side reforms, globalization, privatization, and we get low, normal inflation. In the 2000s, we get more globalization, and we get very low inflation, and then we get the GFC at the end of it. And then from 2009 onwards, we have QE, and we have stagnation again. And then in 2020 and 2021, we have fiscal QE, which is where we basically print money. Money goes into the economy, the central bank pays for it. What do we get? With no supply chains, which are kind of like an empire where we can control the flow of goods, we get inflation again. So the backdrop changes, inflation changes, everything changes. And that's what the British flag is starting to look like today, pretty emerging markety. People are openly talking about it as looking like an emerging market, particularly when you get headlines like that we might have lack of food on the shelves come December and power cuts. Isn't it going to be a fun Christmas, unfortunately? Well, Europe, of course, also has massive issues. This is Dutch TTF baseline gas. Now, we've come down from that peak just slightly, even though gas was up 17% in the day yesterday after Russia announced there won't be any more going through Nord Stream 1. And if anything happens to the other pipeline going through Ukraine, which it easily could, there will have to be outright rationing in Europe. And in fact, let me make this abundantly clear, because this is news since I put these slides together. We will have to see rationing in Europe. There is not going to be enough energy to go around. Now, how do you ration? You can ration by price, but that means everybody gets staggeringly high energy bills. We're already seeing Europe and the UK have no appetite for that. They've announced they're going to be subsidizing energy bills for businesses and for households. Well, and rightly so, because otherwise industry will collapse. I don't mean a recession, I mean a collapse. Households will be in poverty. I don't mean a bit poorer, I mean poverty. So they're going to subsidize. But if you don't ration by price, you have to ration by diktat. You have to decide politically, you get gas, you don't. How are we going to do that? That's called a planned economy. A planned economy. It's no surprise that next week we're likely to see, according to press reports, the European Commission will float new emergency measures within Europe which allow for, effectively, a war economy. The European Commission will be able to tell companies, you have to maintain higher stocks than you want to. You have to sell off your stocks. You have to change your supply chain. You have to rip up that contract. You have to sell to a European firm, not a foreign one. All by diktat. Now, let's see if that comes true or not, but that's being floated. So market mechanisms are likely to be abandoned entirely in Europe. Now, I apologize, the font has come through wrong here for some reason, so maybe not all of this can be read. But a quick rehash of what I just showed you again. The global rules of the game that we based everything on were first set up in 1944, before the end of World War II, when the dollar was pegged to gold, other currencies were pegged to the dollar. We had very little trade between the East and the West because of the Cold War going on there, and we had high interest rates generally, and credit rationing between different sectors, and credit controls as well. So you couldn't move capital between countries very easily. That all collapsed in 1971 when the Americans tried to spend too much money on the Vietnam War and have a big social program at the same time. And we ended up here during the 70s. For those of you who were alive then, I was a child, I do remember power cuts and candles lighting the house in the evening. It was a clash between inflation and unemployment. Here we are again, back in exactly the same position now in 2022. Then we solved the problem not just by raising interest rates, which we did do, but by privatization, globalization, deregulation, and here in the UK, smashing the miners, for example. I remember the miners' strike taking place in the 1980s too. That brought inflation down. Then in the 1990s, we win the Cold War. We think that's it, peace forever. The Japanese economic bubble bursts, their interest rates go to zero, Japanese capital floods around the world, and in the 90s we get a rolling series of credit bubbles in Mexico, in Asia in 1997, hands up who remembers that, I certainly do. And we get the emergence of a new system called Bretton Woods II, where Asia says we run large trade surpluses, but to keep everything stable, we'll invest all that money back in America again, to keep everything ticking over, so everything circulates. Fantastic. Except in 2008 we had the GFC in the West, because they had borrowed too much money, like Asia had in 1997. And what do we do after the GFC? We do the complete opposite of what we told Asia to do in 1997. We told them to slash state spending, we increased it. We told them to raise interest rates, we cut them. We told them to sell everything off at fire sale prices, we bailed out all our friends. Complete and utter hypocrisy. Now, of course, Asia noticed. What did we get as a result? Inequality, low inflation, stagnation, low interest rates. What did China do? They pushed money into the real economy, fiscal QE, built bridges to nowhere and buildings no one wants to live in, but it kept the economy going for a while. But in the backdrop, China and Russia and others, they realized, look, this is a rigged game. This is not a fair system. One rule for us, another rule for you. So, Russia started to change things physically. You could argue China did at the margin too, but both of them started to pivot very, very significantly in terms of talking about a different way of doing things, a different system, a different structure. And then Trump comes along in 2016 and he says exactly the same thing. China, China, China. I'm not going to do a Trump impression. And says, I'm not going to be buying from them anymore. Well, that's the end of Bretton Woods too. That's the end of it. What do we replace it with? What's our global system? I don't know. Does anybody know? Hands up. Nobody knows what the global system is going to be. So then, let's come back to where I started, which is this red bar here in UK inflation heading up to 20%, maybe even higher. And my question to all of you, is this a blip? And within the financial markets, on the bond market side, where I've spent much of my career, a lot of people still say, yeah, it's a blip. Inflation's going to go back to 2%. It's a blip. Okay, that's an argument. Or was everything that happened from 1991 to 2019 a blip? Have things changed structurally? Well, absolutely they have. Because we had COVID, first of all. Now, COVID obviously changed all of our lifestyles for a long time. But one thing it also changed very, very much is it shifted us towards fiscal QE. We started doing what China had been doing, which is giving people money, pumping it into the economy. Except guess what? We don't produce anything. So you pump money into the economy, what can you do? You import. everything tries to get through the same channels. When you've got COVID disruptions in terms of the supply chain, you get inflation. Now what's going to happen in the West? Are we going to turn around to everyone and say, you're 20% poorer than you were last year? Inflation's 20%, you get a 0% pay rise, live with it. Can you name me one politician who can live doing that? No way. So we're going to have student debts written off, everything's going to be subsidized, everyone's going to be made good, and inflation will continue to go through the roof. It's as simple as that. So we do have bottlenecks, absolutely. They're still there. Some of them are improving because demand is slowing down. But this time last year, I was already warning people, inflation is not going to be transitory. It's structural due to the fact that we haven't addressed these problems for a very long time and we're trying to push too much demand into the system. And in fact, I gave a series of presentations some of you may have seen called In Deep Ship with a P, basically saying that's where we were in terms of supply chains and it would take a recession to get prices down. Here's the key point. If we get less trade and less immigration, labor power will increase. Because when you have an import in front of you, that's the physical embodiment of cheaper foreign labor right there in your hand or in your home. Less free trade reverses that. Wage rates will go up. We are seeing them go up. Unionization will creep back. And I refer back to what I said about the 1980s. You have to absolutely try and push unions down as we did back then, if you want to resist it. And you name me a government anywhere that politically is going to be brave enough to do it. And the answer is none. So these things will percolate up. Plus, post-COVID productivity, except in Singapore, is terrible. Try and fly anywhere. Try and do anything internationally the way you used to. Productivity is a fraction of what it used to be. And here's the great irony. Felixstowe Port just had a strike. Liverpool Port is about to strike too in the middle of September. These are just two in the UK. We have concentrated our bottlenecks for so long by not investing enough during the stagnation that followed after 2008, making some people very rich, that the working class can now go on strike and throttle that bottleneck and bring the whole system down. Lenin infamously said, capitalists will sell us the rope with which we will hang them. And that seems to be playing out at the moment. So here's what I want you to understand. The West is losing this economic war because they don't control commodities and they don't control industrial supply chains. And the US, which so many people rely on as being the power that underpins everything, and the US Army behind that, it's no longer the arsenal of democracy. You look at the fantastic American naval vessels sailing around through Singapore, they're quite old. There are no new ones being built. They're all going to retire in the next few years. And as this author notes, America's industrial base could not sustain a war with China. I'm not saying there will be one, by the way, but this is from the Wall Street Journal, the financial press. Were there to be that, America couldn't fight one. No way to replace what they're already using in Ukraine. So what is our global system based on if this American power is evaporating? Meanwhile, in the background, Vladimir Putin is, really banging the table and being very, very obvious and saying he wants a new world order. He's openly talking about the imminent disintegration of the dollar-based financial system. That's you. That's all of us. That's global commodity finance trade. That's dollar-based. He's talking about a new digital currency for new world order countries to price things in and transact in soon. And he's talking about nationalizing commodity production in all these economies that come on board and putting them behind this new currency, not the dollar. And China and Russia are collaborating to some degree, Russia and Turkey to some degree. No one's quite sure exactly who is doing what, but Putin's being very, very adamant about what he wants to achieve. And these kind of changes, if they occur, it's not a forecast, if they occur, they tend to happen alongside wars. Now, what I want to stress here is that we are seeing changes at the margin, but so far the infrastructure is still very much in Western hands. Because, for example, India and Russia are now doing trade in rupees, quote unquote. But if you look on the left, you're well aware of the fact they're thinking in dollars. They're just transacting in rupees to avoid US sanctions. But they're not thinking in rupees or rubles. Saudi Arabia isn't going to sell oil in renminbi, not on any great volume. Their currency is pegged to the dollar. Why would they take that FX risk? It makes no sense for them. And Europe is, or was, paying for Russian gas in euros, not in rubles, however Russia tries to dress it up. But they don't have any gas. So yeah, you control the infrastructure, but you've had all the software cut off. Or you can turn it around the other way, and say we control the software, but we don't have any hardware. You can turn that metaphor around whichever way you want. And as a result, Europe is looking at a war economy and rationing by diktat and closing down entire swathes of industry for years. I'm not exaggerating. That's currently what's on the table. People have not woken up to how serious and imminent the threat is. And meanwhile, commodities cannot help but be rocked by what's going on. And if you look at what happened on the LME in particular in terms of nickel, there's an example. You get a short squeeze, prices go through the roof. What happened on the LME? They shut down, closed off trading, gave people their money back and said that trading didn't happen to bail certain individuals out who happen to be maybe connected to the owners of the LME. This is what's going to happen to more and more commodity trading. We are going to move back to more and more barter, counter-purchase, offset trade. Because if the dollar keeps going up, and it's at a 20-year high on some measures right now as we speak, how do you get hold of the dollar? If you can't export so much to people as global trade slows down and we have a recession, how do you earn dollars? And how do you afford the imports which are priced in dollars when the price is going up at the same time because of this supply squeeze? We are going to see more and more politics entering back into trade where you're trading more and more with friends. And so if that's going to be happening and the world is changing, how can we not tie that back to interest rates? And I address this not to you, but I'm addressing this to any fixed income traders who happen to be sitting in the audience by mistake, because they still keep thinking inflation is going back to 2% and bond yields are going to come back down again. And indeed, one message I do hear from people who listen to me is, okay, Mike, we agree with you, things are looking pretty gloomy, but if things go wrong, the Fed will just cut rates. The ECB will just cut rates. The Bank of England will just cut rates. And I just say again, no, they won't. No, they can't. Because we here in Asia, we know if you have an emerging market economic crisis, what happens? Capital flees. Your currency collapses. Inflation goes through the roof. And you're forced to raise interest rates by the market. That's what happens in an emerging market recession. Only in the West does anything bad happen and we immediately say, oh, we'll just cut rates and print money, it's all right. You can't do that if you don't control commodities and you don't control the currency in which commodities are priced. You can't do that if you don't control supply chains, so you can't actually produce the stuff that you're going to be printing money to buy. So we can't cut interest rates and print money again until we sort out commodities and supply chains, and that's geopolitics. And so as a result, I've been arguing for some time that the US will raise rates not just to target inflation, which they are doing, but to try and flush out commodity speculation and to try and pull cash out of China so they can redirect it into countries for friendshoring. It's a geopolitical weapon. And people said to me, that'll never happen. And I said, well, you said the same thing about crypto. They would never raise rates because it would blow up crypto, and that's worth trillions of dollars. Well, they blew up crypto, didn't they? And every time yields go down, commodities can't go up. So when you see the market pushing up the price of commodities, but bond yields are coming down, that's telling you the market is running ahead of itself, pricing for interest rate cuts. That cannot happen. We have to have commodities going down and yields going down together, but then we've got a global recession, which is only going to encourage decoupling as well, and people saying, okay, we've moved from just in time to just in case, and now we need to move to just for me. But you can expect the unexpected. Here's what I think will happen too. Rates are going to go up, and they're going to come down for some lucky people. We are going to see central banks raising rates and printing money for the government to spend on what they think is important. So regardless of how high the borrowing cost is for the private sector, the public sector gets to borrow for free. That's going to happen. If you're important, you borrow at that rate. If you're unimportant, you borrow at that rate. That's how we did things under Bretton Woods. That's how we are going to do things again. It may seem illogical in terms of how we do everything at the moment, but history says we'll do it. Logic says we will have to do it too. Because how else are we going to reallocate scarce resources? Because we have scarce resources again. We've just had years of central banks telling us we can't get inflation up, we can't get demand up. Let's create a new liquidity acronym to try and make people spend money. Now we don't have enough stuff. That's what economics is supposed to be about. Understanding we don't have enough stuff. How do we allocate resources properly? We've forgotten that. We're going to have to do it with interest rates. Because here's Churchill on a stamp in America. In the late 1930s, he was saying, the British army isn't ready for a war with Germany. We don't have anything that we can fight with. It's a disaster. And he said to the Brits when the war started, I have nothing to offer you but blood, toil, tears and sweat. What he didn't say is, and lower taxes and higher house prices and NFTs of monkeys wearing sunglasses. You don't get to have the fun stuff when you're trying to reallocate resources for an existential war. And that's pretty much what this is. And so I'm moving towards the conclusion here now. What you can see in the middle is a map of what the world may look like going forward, where instead of everyone being in one bubble together, we get a much more fragmented, disjointed world. And the simple message that central banks didn't lower inflation, globalization did. If we have less globalization, we'll have higher inflation on various different fronts. We can't just cut rates and say, don't worry, inflation will go back down 2% again. It won't do if that structure is changing. Different central bank responses are going to create massive volatility, as between America on one hand and Japan on the other, and the yen collapsing, for example. And commodities are absolutely in the firing line of this. They're slap bang in the middle in terms of what currency they're going to be priced in and what mechanism they will use to be traded between different partners. And none of this is going to be resolved until we sort out the geopolitics of what the New World Order is going to look like, and I have no idea when or if that will happen. And so until then, lower for longer under US globalized hegemony risks being higher for longer with much more volatility under deglobalization. So I will leave it there. Thank you very much for your attention, and I believe we have time for some Q&A. Thank you.
Well, Michael Every, I now know everything about the crisis, but I have some questions that came in on the app, but I have one I just want to ask you, because you're painting a pretty drastic picture, okay? And you sound very confident, and I know you know what you're talking about, but if you had to be wrong about one of these, dare I say, predictions, what might that one thing you might be wrong about?
Thank you. My wife loves to ask me that question. When my wife, the answer is I'm wrong about everything, dear. Fundamentally, it's this. What I'm putting forward is a thesis based on my own personal philosophy of how markets work and how things work in the long run, which is that politics works over markets. If I'm wrong on anything, it's that markets work over politics. So if you want to take the view that the market will win and politics goes away, pretty much everything I've just said here doesn't matter. Inflation will go back to 2%. We'll all continue trading because it's more efficient. And you can take that view. I have the opposite stance because history is littered with potholes and wars and all kinds of bad things happening. But feel free to take the opposite view.
Yeah, I think your background data supports your contention. On the app, we have a few questions, 3. They won't take me long. And first of all, inflation, okay? Inflation is a problem everywhere, but in Asia, not so big a problem. Is that because of the different approach to Russia and the war in Ukraine?
Primarily in Asia, it's because Asia makes everything. If you make everything, pretty much you have all the stuff. And in the West, we don't make anything, so we've had the demand without the ability to actually manufacture anything, so supply-demand. Asia's the other way around. But what you have to stress is, particularly in China's case, for example, where inflation is very low, that's also a representation of utter economic failure. Utter economic failure. You're making too much stuff, and you haven't got enough demand for it. That's also really, really bad. It would be far healthier if Chinese inflation, odd as it sounds, was a bit higher at this point, because it would show that demand was really picking up again, but they're flat on their back.
Really, Michael, you have a talent for making all these complex things, even I can understand them, so that's really amazing. Okay. Next question is China-Taiwan. Is the world underestimating the risk?
Well, I guess it depends what you mean by the world. Nobody knows what will happen there, and I'm not making any kind of prediction, and I want to make that abundantly clear. All I can say is that far smarter and better connected people than me look at the current trajectory and worry that it's heading towards a crisis of some sort at some indefinite point in the future. And you can read the runes in lots of different ways. It seems hard to draw the conclusion that that is not going to be a crisis or cannot be a crisis at any point. So it's very hard to say that.
So we may meet a crisis, metacrisis, I guess so, yeah, okay. Okay, final question so far, but I think we'll have time for one or two more, and yeah, Jeff has one or two more. And it's regarding, have we been overestimating the value of growth in an economy? Take Japan, for example. There has not been growth for 20 years, but yet these guys are doing pretty good.
Well, that's an interesting philosophical question. At the end of the day, it comes down to the size of your population. If your population is flat or shrinking, you don't actually need to grow per se, because it's GDP per capita that actually matters. And Japan's population has been shrinking for most of the period in which they haven't had any growth. I mean, Japan has lots of very peculiar economic qualities and great strengths and great weaknesses. Certainly, they're very reliant on Western demand. If no one in the West was buying Japanese products, they would have negative growth rather than just flat growth. So I'm not personally in this we don't need to growth club, we don't need to grow club. I think there are good and bad ways to grow, but I'm not an advocate for the growth is not a thing.
Really, really good answer. Next question is, it sounds like the outlook for Asia is better than the outlook for the West, but just look close at hand to Sri Lanka and the bankruptcy, other problems, etc. Your insights on the outlook for Asia, given what's happening in nearby markets?
Well, Asia is a very big place, and absolutely. I mean, when you're talking about Sri Lanka, which is desperately worrying, or the floods in Pakistan, there are any number of issues that we can look at and be seriously, seriously concerned about. Right now, yeah, Europe, the UK, in terrible, terrible trouble. The US is not doing too well either. But Asia's problem is going to be that as this Bretton Woods 2 breaks down, who do they sell to? If you've built up supply chains based on we build it, we sell it to you, and then the other side says we don't want to buy it, what do you do with all that capital stock? That has yet to be addressed, and the entire regional supply chain is still sell stuff to China, China makes stuff, China sells it to the West. That is going away. That is going away.
That is going away. Next question on the app, coming in on the app. We're all engaged in trade finance. It sounds like country risk is going to grow through the roof.
Yes.
Okay. Right, country risk is going through the roof. And finally, regarding trade compliance and sanctions, again, well, these are not the words, but I'm making it short. It sounds like that's also going to go through the roof for operators.
Well, working in banking, we can all agree compliance has been going through the roof for a very long time anyway. Given compliance officers just like saying no to everything, it's you wonder why it takes so long to come to those decisions. But clearly, all joking aside, yeah, it's going to become much, much, much more complicated going forward. And if you look at the slew of pipeline American legislation in Congress at the moment related to various aspects of this, which will put even more layers of potential risk of compliance problems in front of us, yeah, people are going to be very, very busy poring over very thick tomes looking at potential legal problems.
Really, absolutely. We're all talking about standardization, but in terms of compliance, the standardization is going out the window. But the final question here is that, well, in all of this mayhem, where is the golden egg of opportunity in the world for trade?
Well, okay, this does seem very negative. I understand that. It's negative if you want things to be the way they've always been. If that's what you want to cling to, nothing can ever change. Yeah, it's negative. There's enormous opportunity in this. There has been enormous opportunity in the past 6 months already for those who have traded it correctly. There will be fantastic opportunities for those who continue to trade it correctly, who can see the lie of the land going forward, who can understand what the new trade constellations will look like, and who front run them and get there. The people who don't want to accept change, they're the losers in this.
Wow, really, really, really insightful, really, really interesting. And then I'll turn to the audience after this one, the last one we have here. And this was, regarding interest rates, and the interest rates gone up in the US. Typically, there's a time lag in emerging markets. Is that time lag going to be shorter this time than before?
Well, traditionally, the time lag is the Fed raise interest rates and then something blows up somewhere and then they have to put them down again. And, that's the way it works globally. The question is the thing that blows up something that the Fed cares about? And if it's the stock market in America, maybe they do. And again, the people who think rates are coming straight back down again point to that argument. They have some validity. That could happen. If it does, by the way, the volatility we will then see in everything will be mega because the dollar will collapse. If the Fed's given an indication that that's it, Wall Street's come off another 5%, geopolitics doesn't matter, dollar through the floor, commodity prices through the roof, inflation through the roof, it's been fun knowing you. So I don't actually see that happening, but I could be wrong.
Okay, and that's all the questions on the app, all we're going to answer on the app. But I'm sure someone in the audience maybe has a burning question. You want to raise your hand and ask Michael. It's just such a wonderful presentation. Anyone down here at the back? We have a familiar face.
Thanks, Vic. I have a question. I come from India. My name is Kamlesh Thakur. I have witnessed many people in India who look at palms and predict the future. And their reliability comes from how well they predicted the past. You've done an excellent job in telling us what we went through. Is there an insight you have that you could share about the future? What should happen and how do you see it happening?
Thank you for the question. Let me go back to ancient wisdom. There is nothing new under the sun. What was will be. I don't believe we ever enter into completely new territory or new waters. We just replay in various iterations aspects of what has been seen before. And so you are free, as everyone is, to choose any particular period from the past and say, yep, we're going to go for this one or that one or this one. My own personal view is that we are going back to something that looks more like the 19th century, where you have what we call mercantilism, or more militaristic, closed blocks trading together more opportunistically, with an element of maybe the Cold War thrown in too, in terms of who is siding with who. That's what I think, but it's a rapidly changing situation, and lots of other views have validity as well.
Wonderful, Michael. Well, to be prepared for the past, you need to prepare for the future. You need to study the past. And I think we've one final question over here, and then we'll take the break. Over here, microphone, just here at the front. Yeah, just, it's coming, so everyone can hear you.
The microphone's behind you, sir.
There you go.
My question was very simple. When you said US friendshoring, now how is it going to affect China?
It's a disaster for China. Friendshoring is a disaster for China. We did a piece of analysis looking at very carefully quantifying where are the production facilities within China that produce for Western economies. And the bullet point answer is around 28 million jobs maximum, without second order or third order effects, people who are employed selling to those people, but directly 28 million jobs could theoretically shift to other producers around the world who have a similar cost structure to China, were the West to put in place tariff and tax incentives and openly encourage companies to do that. India would be one of the big winners, obviously, but there are some surprising countries on the list that could actually benefit.
Yeah, thanks.
Michael Every, Rabobank, can we please give him a big round of applause? Really wonderful, Michael. Tremendous.